Alright, we are now going to topic number 3, working with financial statement. These are the key concepts and the keys that you will be learning in this topic. And here is the outline. Let's go to the first outline, standardized financial statement. What is meant by common size balance sheets? It means computing all accounts in balance sheet as a percent of total assets. Let's look at this slide. The balance sheet on your right hand side is a common size balance sheet. All accounts are computed as a percent of total assets. For example, cash. Cash equal 2.5% in 2007. That is cash of $84 divided by total asset of $3375. Right? The same applies to other percentages in the balance sheet. What is meant by common size income statement? It means computing all items in income statement as a percentage of sales. Look at this slide. The income statement on your right hand side is a common size income statement. All items are computed as a percent of sales. Example, interest paid is 6.1%. That is, interest paid of 141 divided by total sales of 2311. The same applies to other percentages in the income statement that you can see on your right hand side. Why do we need to have common size financial statement? By standardizing financial statements, it makes it easier for all stakeholders to compare financial information and performance of companies of different sizes, particularly within the same industry. Ratio analysis. Ratios allow for doing a time trend analysis and peer group analysis. Right? What is time trend analysis? Time trend analysis is to see the firm's performance across time, and peer group analysis is to see the firm's performance compared to the other firms in the same industry. These ratios are used both internally and externally. There are 5 categories of financial ratios, namely short-term solvency or liquidity ratios, long-term solvency or financial leverage ratios, asset management or turnover ratios, profitability ratios, and market value ratios. All calculations of financial ratios that you will be seeing later are based on the figures on slide number 8 and 9, balance sheet and income statement. Now, we are going to the first category of financial ratio, liquidity ratios. What is liquidity ratio? Liquidity ratio is used to determine a company's ability to pay off its short-term debt obligations. There are current ratios, quick ratio, and cash ratio. Alright, we are going to the first category. There is liquidity ratio. What is meant by liquidity ratio? Liquidity ratio is used to determine a company's ability to pay off its short-term debt obligations. There are current ratios, quick ratios, and cash ratios. Alright, look at the first one, current ratio. This ratio is mainly used to give an idea of the company's ability to pay back its short-term liabilities with its short-term assets, example like cash, inventory, and receivables. The higher the current ratio, the more capable the firm is paying off its obligations. The current ratio of 1.24 times shows that the company is capable in paying its obligation. If the company owes current liabilities of 1 ringgit, it has 1 ringgit and 24 cents of current assets to pay it off. A ratio under 1 suggests that the company would be unable to pay off its obligations if they came due at a point. While this shows that the company is not in good financial health, but it doesn't necessarily mean that it will go bankrupt, as there are many ways to access financing, but it is definitely not a good sign. Next ratio, quick ratio. What is meant by quick ratio? Quick ratio measures a company's ability to meet its short-term obligations with its most liquid assets. The higher the quick ratio, the better the position of the company. The quick ratio is computed as current assets minus inventory divided by current liabilities, which is also known as asset test ratio or the quick assets ratio. It excludes inventory from current assets. Inventory is excluded because some companies have difficulty turning their inventory into cash. Quick ratios of 1.09 times shows that the company is able to meet its short-term obligations with its most liquid assets. If the company owes current liabilities of 1 ringgit, it has 1 ringgit and 24 cents most liquid assets to pay it off. Next, cash ratio, which is the ratio of a company's total cash to its current liabilities. It can determine if and how quickly the company can repay its short-term debt. A strong cash ratio is useful for creditors when deciding how much debt they would be willing to extend to the asking party, the firm. Cash ratio of 0.346 times shows that most probably this firm is unable to completely pay off its current liabilities balance with its cash. Now we are going to the second category of financial ratios, leverage ratio. Leverage ratios is to get an idea of the company's methods of financing or to measure its ability to meet financial obligations. There are total debt ratio, debt equity ratio, and equity multiplier. These are the leverage ratios. Alright, we are going to the first ratio, total debt ratio. Total debt ratio compares a company's total debt or liability to its total assets. A low percentage means the firm is less dependent on leverage, which is the money borrowed from others. The lower the percentage, the less leverage the company is using and the stronger its equity position. In general, the higher the ratio, the more risk that the company is considered to have taken on. Total debt ratios of 49.1% shows that the company finances 49.1% of their assets with debt. Second ratio, debt equity ratio. Debt equity ratio is equal to long-term debt divided by common shareholders' equity. If the ratio is greater than 1, the majority of assets are financed through debt. If it is smaller than 1, assets are primarily financed through equity. Equity multiplier. The formula for equity multiplier is total assets divided by stockholders' equity, or 1 plus debt equity ratio. This ratio shows the company's total assets per dollar of stockholders' equity. A higher equity multiplier indicates higher financial leverage, which means the company is relying on more debt to finance its assets. Hence, this firm having equity multiplier of 1.964 would mean that the firm uses more debt than equity to finance its assets. Next slide. Times interest earned. Higher value of time interest earned ratio is variable, meaning greater ability of a firm to repay its interest. Lower values are unfavorable. A ratio of 1 means that income before interest and taxes, EBIT, of the firm is just enough to pay off its interest payment. Creditors compare the debt repayment ability of similar companies using this ratio. Other things equal, a creditor would lend to a company with highest times interest earned ratio. It is also beneficial to create a trend of time interest earned ratio. So, times interest earned ratios of 203 times shows high ability of the firm to repay its interest payment. And the last ratio of leverage ratio is cash coverage. Cash coverage ratio is EBIT plus depreciation plus amortization divided by interest expense. The cash coverage ratio is used to determine if a firm has adequate funds to pay for interest. Ratio higher than 1 is better. A ratio lower than 1 typically shows the firm is going to bankrupt soon. This cash coverage of 225 times shows that the firm has enough funds of 225 ringgit to pay for interest expense of 1 ringgit. Alright, now we are going to the third category of financial ratios. There is asset management or turnover ratio. Now, what is asset management ratios? Asset management ratios compare the assets of a company to its sales revenue. It indicates how successfully a company is utilizing its assets to generate revenues. Asset management ratios are also known as turnover ratios or inventory ratios. Asset management ratios are computed for different assets. Common examples of asset turnover ratios include inventory turnover, days sales in inventory, receivable turnover, and days sales in receivable. Let's look at the first one. There's inventory turnover. Inventory turnover tells how many times the company's inventory is sold and replaced over a period. It can be calculated as cost of goods sold divided by inventory. This ratio should be compared against industry average. So you have to compare this ratio to industry average. A low turnover implies poor sales and therefore having too much of inventory on hand. A high ratio implies either strong sales or ineffective buying. Next, days sales in inventory. This is a way to measure the average amount of time that it takes for a company to convert its inventory into sales. A relatively small number of days sales in inventory indicates that a company is more efficient at selling off its inventory, while a large number indicates that a company may have invested too much in inventory. However, a large number may also mean that a company's management has decided to maintain high level of inventory in order to achieve high order fulfillment rates. Next, receivables turnover. Receivable turnover is a measure of how quickly a company is collecting its sales that were made on credit. The calculation of receivable turnover is to divide net credit sales for the year by the amount of accounts receivable outstanding during that period. A high turnover figure indicates that a firm has the ability to collect accounts receivables from its customer very quickly, while a low turnover figure indicates ineffectiveness and inefficiency in collecting outstanding sales. You should track the receivable turnover metric on a trend line in order to see gradual changes in turnover performance. Days sales in receivable. If you want to convert the receivable turnover figure into days sales in accounts receivable, just divide the receivable turnover amount into 365 or 360 days, depending on the question. So, a receivable turnover of 4.99 times equal to 73 days of accounts receivable outstanding, calculated as 365 days divided by 4.99 receivables turnover. It tells you the average number of days it takes to collect an account receivable. Total asset turnover. The ratio measures the ability of a company to use its asset to effectively generate sales. That is, how much in sales is generated by each dollar of firm assets. This ratio considers all assets, both current and fixed assets. The calculation for the total asset turnover ratio is net sales divided by total assets. The lower the total asset turnover ratio as compared to historical data for the firm and industry data, the slower the firm sales. This may indicate a problem with one or more of the assets categories comprising total assets, like inventory, receivable, or fixed assets. Liquidity ratios, such as current and quick ratios, may be linked with this total asset turnover. So you are to trace back to these liquidity ratios if you find something incorrect for the total asset turnover. What if the total asset turnover is excellent as compared to historical data for the firm and to industry data? That means your firm is utilizing all its assets efficiently to generate sales, and that is a very good thing. Next, capital intensity ratio, CIR. It measures how much a company is invested in total assets compared to how much it is earning in revenue. It is calculated by dividing the value of its total assets in a specific time period by the amount of revenue it has earned in the same period. What the capital intensity ratio shows is just how much capital it takes a company to generate a single dollar of revenue. It is the reverse of the total asset turnover. Like all financial ratios, this one is best used when comparing companies in the same industry to another. We are going to the fourth financial ratios. There is profitability ratio. Profitability ratios indicate how well a firm is performing in terms of its ability to generate profits. They are profit margin, ROA, and ROE. Let's look at profit margin. Profit margin is an accounting measure of bottom line profit per dollar of sales. And ROA is a measure of bottom line profit per dollar of total asset. And ROE is a measure of bottom line profit per dollar of equity. A higher profitability ratios relative to a competitor's ratio or the same ratios from a previous period is indicative that the company is doing very well. Alright, now the higher the better for all profitability ratios. Now we are going to the last category of financial ratios, that is market value ratio. Alright, market price. Market price is the price per share. $91.54 means it is priced at $91.54 on 31st December 2004. Shares outstanding are all the shares of a firm that have been authorized, issued, and purchased by investors, and they are held by investors. They have rights and represent ownerships in the corporation by the person that holds the shares. Number 3. Market to book ratio. It reflects how much value per share the market places on a dollar of accounting earnings of a firm. PE ratio is defined as market price per share divided by earning per share. Stock with higher forecast earning growth will usually have a higher PE, and those expected to have lower earnings growth will usually have a lower PE. Investor can use the PE ratio to compare the value of stocks. If one stock has a PE twice that of another stock, all things being equal, then it is a less attractive investment because the price of it is too high. PE ratio is generally useful for comparing valuation of companies in the similar sector or group. Alright, next, market, just now that one was for PE ratio. There is price per share divided by earning per share. And we are going to the last category, which is market value measure. We are going to the last category of market value ratio, that is market to book value ratio. Market to book ratio is the ratio used to find the value of a company by comparing the book value of a company to its market value. Book value is calculated by looking at the firm's historical cost or accounting value. Market value is determined in the stock market through its market capitalization. So the formula is book is market value per share divided by book value per share, or market value of firm divided by book value of firm. Table 3.5 summarizes formulas of all 5 categories of financial ratios that you have seen just now. Right, from liquidity ratios to the last type of financial ratios, that is market value ratio. Alright, we are now coming to ROE again. You learn ROE on slide number 16. But now we derive the ROE using different method, which we call it as DuPont identity. What is DuPont identity? DuPont identity is an expression that breaks ROE down into three parts: profit margin, total asset turnover, and financial leverage. Referring to slide 16, right? ROE is net income divided by total equity. Now we can derive ROE using DuPont method. So using DuPont method, ROE equals profit margin times total asset turnover times equity multiplier. It means ROE equals PM times TAT times EM. Now, are these actually the same? The formula that you learned on slide 16 is the same as this, ROE using DuPont method? Yes, they are the same. Let's look at the next formula. If ROE equal PM times TAT times EM, then ROE equal net income divided by sales. What is this? This is the formula of profit margin. Alright, then what about that you can see on slide 16? Then what about sales divided by TA, total asset? That is the total asset turnover formula that you can see on slide 50. And TA divided by TE, that is equity multiplier that you can see on slide 11. Now, when all these three variables combine, then you see actually ROE equal NI divided by TE. Sales, both sales can be offset and both TA can be offset. So now ROE is left with net income divided by total equity. So ROE using DuPont method is the same as ROE formula that is written on slide 16. Alright, you can see from here. 14.41 you can get from slide 60. 0.896 get from slide 50. And 1.964 get from slide 11. Alright. So the ROE equal 25.36% if we use DuPont method, while if we use formula on slide 16, you get 25.34%. The small difference is due to rounding up and down problem. Alright. Then why do we use DuPont identity? Why not directly using the formula written on slide 16? It's because DuPont identity tells us that ROE is affected by three things. They are operating efficiency, which is measured by profit margin, asset management efficiency, which is measured by total asset turnover, and financial leverage, which is measured by equity multiplier. Is able to tell us the problem of the company. For example, if a company is having ROE of 20%, this would seem to be doing well, but this figure may be misleading. If it were marginally profitable, it means low profit margin, and highly leveraged means high equity multiplier. Now, because if PM low, profit margin is low, equity multiplier is high, so when they are multiplied, then it is balanced. One high, one low, so it is balanced. So based on ROE figure alone, it looks well, but actually there is a problem with PM, profit margin, because it is low. So after combining with TAT and EM, so it looks okay. So means ROE is actually able to tell us the problem of the company if we to use ROE using DuPont identity. Now we are going to payout and retention ratios. What is payout ratio? A payout ratio payout dividend payout ratio 1 minus B is the rate of which a company distributes earnings to its shareholders in the form of dividends. For example, a company that earns $3.92 a share and pays out 1.2 a share has a payout ratio of 30.61%. A higher ratio indicates that a company pays more in dividends and thus reinvests less of its earnings into the company. Retention ratio indicates that the percentage of a company's earnings that are not paid out in dividends but credited to retained earnings. It is the opposite of the dividend payout ratio. So, retention ratio B equal 1 minus dividend payout ratio and also equal retained earnings divided by net income. The payout ratio is the number of dividends the company pay out dividend by the net income. This formula can be rearranged to show that the retention ratio plus payout ratio equals 1, or essentially 100%. That is to say that the amount paid out in dividends plus the amount kept by the company comprises all of net income. Hence, 30.61% of dividend payout ratio plus retention ratio of 69.39% equal 100% of net income. Alright. The internal growth rate. The internal growth rate is the maximum rate of growth a given company is able to achieve without outside sources of funding. So, no debt, no common, and no preferred shares. The formula is shown here. This is the formula. ROA is obtained from slide number 16, 0.1290. B is obtained from slide 21, is 0.6939. Alright, combine and you will get internal growth rate of 9.83%. Now, since the firm relies solely on retained earnings, this will increase equity as our retained earnings are part of equity. And because no debt funding, the firm's leverage will decrease over time. Alright, now if there is an optimal amount of leverage, then the firm may want to borrow to maintain that optimal level of leverage, meaning optimal level of using retained earnings and debt. Now, that is the sustainable growth rate that you can see on this slide. Now, a sustainable growth rate is the maximum growth rate that the company can sustain without having to increase financial leverage. This formula assumes that the firm wants to maintain a target capital structure without issuing any new equity and maintain a debt equity ratio. Alright, so you can get the ROE from the ROE figure from the previous slides and B from the previous slides. Alright, after combining you get a rate of 21.33%. Next, determinants of growth. Determinants of growth are profit margin, total asset turnover, financial leverage, and dividend policy. Combination of profit margin, total asset turnover, financial leverage, result in ROE, which explained earlier that ROE derived by using Dupont method. Now, table 3.7 summarizes the formulas of internal growth rate and sustainable growth rate. Now, why do we evaluate financial statement? The key use of ratios is to examine trends and identify problems. Ratios will never solve problems, but they might help to identify the factors behind your business financial problems. Ratios can be used to measure a company today against its historical numbers, which is time trend analysis. They can also be used to evaluate one stock in an industry versus another in the same industry, that is peer group analysis. Alright, that's the one. Now, SIC and NAICS codes are meant for stock exchange in US. There's no formulation stock market. The next slide, the WAP is also meant for US market. Alright, we are now coming to the quick pass. Alright, first question, how do you standardize balance sheets and income statement, and why is standardization useful? You may get the answer from slide number 3. Next, what are the major categories of ratios and how do you compute specific ratios within each category? You may get all formulas on slide 18. Next, what are the major determinants of a firm's growth potential? It is written on slide 25. And the last question, what are some of the problems associated with financial statement analysis? You may refer to slide 28. It says ratios are not very helpful by themselves, so they need to be compared to something. Alright, that's it for the quick ratio. Alright, we are coming to the comprehensive problem. You are given this info: sales 8 million, PM 8% profit margin, current asset 2 million, fixed asset 6 million, net working capital 1 million, and long-term debt 3 million. You are asked to compute the ROE using the two-point analysis. Now, two-point analysis means ROE equals profit margin times total asset turnover times equity multiplier. Now, profit margin is given to you in the question, 8%. So we substitute. Now, your job is to look for TAT, total asset turnover. Now, how to get TAT? TAT is sales divided by total asset. Sales is given to you, 8 million, and total asset is also given to you. It is current asset plus fixed asset, 2 million plus 6 million equal 8 million. So TAT equals 1. Next is equity multiplier. Equity multiplier equals asset divided by equity. Now there's no problem with asset as you obtained earlier. Total asset equal 8 million. What about total equity? 4 million. How do you get this equity of 4 million? Equity equal total asset minus total liabilities. Given that total asset is 8 million, so total liability. Now, if you look at the question, you are given long-term debt. There is long-term liability of 3 million. So you now need to look for current liabilities. Now, current liabilities can be found using the formula of net working capital. Net working capital equal current asset minus current liabilities. Now you have net working capital of 1 million, current asset of 2 million. To find current liabilities, you are to use current asset 2 million minus net working capital of 1 million. So you get current liabilities of 1 million. So current liabilities of 1 million plus long-term liabilities of 3 million, you get 4 million in total for the total liabilities. So equity equals total asset of 8 million minus total liabilities of 4 million. So equity equals 4 million. Substitute into the equity multiplier formula, then you get 2. And now if we use two-part method for ROE, then you get PM times TAT times EM, that is 8% times 1 times 2, you get 16%. Now, this question, if it means that ROE without using two-part method, the formula is net income divided by total equity is actually same as 16% if we use two-part method. Alright, now that's the end of this lecture. Alright, let's talk about group assignment. The group list, refer to your group assignment sheet. The group list is to make available to your tutor by teaching week 4, ending 17 April 2013. So you are to submit your selected listed company that you wish to analyze to your tutor latest by 17 April of 2013. Now, what do you need to do for your assignment? Alright, now it says that you are now working in a company called PMP. Alright, and your team is now assigned by the finance director of PMP to evaluate whether your selected company is a good investment to meet the diversification objective of PMP or not. Now, in your report, you must cover all these 5 items. First, background of the selected listed company. So you must cover the track record of the company and its industry, advantages of its products, potential growth opportunities, management, and etc. Next, you must mention about its financial goal of the selected company. Now, what is the financial goal of the firm? Alright, by how you know this? Read the annual report or read the company's website. Now, after that, decide if this company should pursue its current financial goal. Justify your answer. Now, the number 3 part is about financial analysis. Now, you are to collect latest 3 historical years of annual report of the company. Now, you can choose to calculate the ratios by yourself if you couldn't find them on internet. Now, if you could find them on the internet, then you need not to calculate by yourself. Now, so what you need to do is, now you got to explain, right? You got to explain the ratio value and explain why and how these ratios behave in certain manner. For example, what caused this ratio to drop drastically in certain years? What happened? Alright, you have to find out and to provide evidence on this. For question 1 to 5, you are to provide evidence to support what you say. Now, number 4, summary of overall merits and risks. So you have to tell the advantages and disadvantages of involving in this listed company, this investment. And lastly, recommend if this is a suitable investment for the company to diversify or not, and then explain why. Then 4 marks given for writing skill and flow of presentation, and 5 marks given for the resources and references. Now, all assumptions you must make clearly in the report, and then you are required to look into 5 categories of financial ratio analysis. The 5 categories you have already learned in the lecture just now. Alright, this is the marking scheme. You go through the marking scheme and work accordingly. Alright, the due date is on Thursday of midnight, and the rest of the day read through carefully. Alright, so must remember 17 April of 2013, you must submit your group list to the tutor. Alright, this is about group assignment. You have another individual assignment. There's a review of current news event. Alright, so and the due date is on 25th April 2013 by 2 o'clock. Alright, That's the end of the whole lecture. Alright, I will stop here.